Jay, I love Jay's picture.
He's good at holding
Cool is
that pose. He holds that pose a lot. Look at him.
Yeah.
It's good.
I could nearly, if I grew a beard, I could nearly have that pose too.
And you guys are all obviously at home down in Victoria.
Yeah, we're lucky not being in the Melbourne bubble, but we're still just working from home, a bit more conservative. So
we're just a bit worried when you cough like that.
Yeah, I know. You got to be careful when you're around.
Well, are you lucky you're down to 300 or something now?
Yeah, I'm lucky I don't live in Melbourne, so I don't really mind. I stay sheltered in my Geelong bubble and stay away from that the dirty Melburnians.
Yeah. The Medi Creek down to Geelong?
They did have one, I think it was a cafe that said they turned away 80 people in a weekend. So there's lots of people taking back roads to try and get out and escape. But yeah, it's a crazy time, isn't it?
That's great.
Jeez.
Hey, why don't we do this more laissez-faire? Yeah, because you know how we did the last one, Louise, and we were it was a bit more formal. I felt that it probably, with a small group, we've got to be a bit more.
Well, we can be. We obviously can be. We just got to make sure we give our fund managers enough time to, you know.
You'd probably lead with them. I'd lead with
them. Well, we can. Absolutely. Hi, Peter. He's on mute.
Yeah. You're on mute, Pete.
You're on mute, mate.
Good afternoon, guys. My apologies.
Hello,
Graham and Martyn. Nice to meet you guys.
Good. Well, listen, why don't we do that then? Normally we start with us talking about performance and divvies, whatever, but why don't we start with the two fund managers? It might be, just good change of because it is a small group. You're absolutely right, Geoff. So
and then they can move on. Yeah, they don't.
Yes, that's very true. Well, look, why don't we kick off? Is Mark on? I'm not sure. Mark, are you on? I'm not sure that Mark's on yet. That's it. Well, why don't we start with Graham first then? So, because Marcus not here yet, Geoff, so he might be coming on a little bit later, that's all. But Graham, if you're happy, we've got Graham Hay that we're delighted to have with us, who's the portfolio manager of Antipodes, one of our FGG fund managers. And we've just asked Graham to have a bit of a chat with you about the market outlook, how the portfolio is being positioned in light of COVID and a stock pick. And then Mark Landau will follow from L1. But it's an opportunity for you guys to ask them anything you like. And then between Geoff, Marty and I, we'll cover off on performance, dividends and growth and what we're doing to close the discounts as well, if that's all right with you.
Perfect. Sounds good.
Sounds great. All right, Graham, I might hand it over to you then. Thank you.
Thank you. Sure. Look, we live in interesting times, as you guys have already been discussing, and I think it's you kind of got to take stock of what's transpired over the last 6 months. It's quite unprecedented on lots of different levels, and I mean, I think governments, obviously the pandemic has come and made its way through economies throughout the world, and that's caused we've all been part of it, and we've witnessed what's happened. The response by governments, though, I think has been quite remarkable. We won't know for probably some years as to the full after effects of that response. But it comes at a time when we have a fracturing of the sort of geopolitical landscape at the same time. And so there's lots of fascinating cross currents that are, driving asset prices right now. And it makes for a very interesting landscape from an investment standpoint. So, I mean, just to, the fiscal response, though, just to put it into context, what we've seen, I like to use the analogy of companies when you think about how much money's been added to the system. And the US Federal Reserve plus the fiscal response to date has added, in effect, a Microsoft and an Apple combined to the financial system. Those two companies took 45 years to get to where they are today. And in a matter of 6 weeks, we've added those two entities in financial terms to the system. So almost 25% of GDP has been added to the system. And with the GFC still relatively fresh in people's minds, the playbook for how to respond was still, on the front shelf. And so that was dusted off. It was squared and then implemented. And here we are. So you've had this really interesting situation whereby, and we've seen this in Australia as well, whereby although unemployment levels have gone up, income levels have not fallen that much. So it's a very perverse set of circumstances. You look at the headline numbers and you think, oh my God, we should be in a deep depression already. But such has been the level of government assistance across economies that people have been able to more or less keep their standards of living intact. Now, obviously, there's been some impact, and we see it in the numbers, but it has headed off the worst of what could have been. Now, the next round of stimulus, a lot of the early programs are now coming up for expiration, and I think every government around the world is grappling with just how to pivot from here. There's no, that's probably where there isn't a playbook just yet, but I suspect we're going to get extensions like the one we've had announced in Australia, simply because the political fallout of what's happening is frankly too great to bear. And there is the hope that on the horizon, there is a vaccine that could rectify all of this, but that remains very uncertain. So, it's a fascinating time. We've obviously seen the corollary of this as a breakout in gold. That has, this week has gone through the 2011 highs, and we've had a very sharp rebound in silver along with it. And so with the amount of monetary debasement that is going on around the globe, it seems inevitable that real asset prices, hard asset prices, continue to be well bid. And gold has featured as a part of our portfolio for a number of years, and is contributing nicely now, happy to say. So that's interesting. The other really interesting thing is just the situation with the US and China, and the fracturing of trade lines that have really been the underpinning of global growth over the last 20 years. And we are seeing, part of the stimulus program that we see it in Japan, we see it in the US, is an attempt by governments to assist companies to reshore, to bring manufacturing back to the home country, and to cut off some of the risks associated with, I don't want to be politically incorrect here, but some of the risks associated with having your manufacturing in less than friendly political regimes. And so that's very interesting. If you think about the impact of low-cost manufacturing on deflation over the last 20 years, it has been probably the single greatest force driving down the cost of living. Now, we've had outsized growth in services inflation, the stuff that we all live and breathe every day, healthcare, education, and that sort of thing. But goods inflation has been in a one-way downward trend. And the reshoring trend could well spell the end of that. Certainly introduce more volatility into the inflation data. And so that's something that I think investors may need to get used to, and the bond market, for all of the wisdom embedded in that asset class, indeed may have to get its arms around a much more volatile inflation series going forward because of these trends towards reshoring. So look, that's sort of the backdrop we have. I mean, in amongst all of that, there's always interesting companies and stocks. Europe for us, out of all of this mess, Europe is actually emerging as a very interesting region because I think the crisis has really brought the region together, and there is a new a platform now, I think, in Europe for a coordinated fiscal response. That is something that's been missing in past crises, and it wasn't really part of the European sort of fabric historically. But the agreement that's been put in place that's enabled what people are now calling the European Green Deal, we think is a very interesting platform, both to help drive fiscal stimulus, but also to decarbonize Europe's power sector. And so if you think through the potential impacts of that, on the demand for renewables, we think that there is a very interesting, perhaps decade-long investment cycle that will play out in Europe that will drive the region towards carbon neutrality by sort of 2030, 2035. And so you can think through a number of beneficiaries of that happening across the wind sector, across the industrial sector, across the general parts of the technology supply chain that help enable decarbonisation. And certainly that's been a big focus at Antipodes over the last 3 or 4 months, is just getting our heads around how that plays out, the magnitude of it, and the key beneficiaries. And so, the angles that we have, for example, the wind sector is very interesting. Wind will be responsible for a disproportionate amount of the growth in renewables, and it's a relatively concentrated market. You have a clear industry leader in Vestas, the Danish company that provides the turbines, and you have a challenger that is very strong in offshore wind in Siemens Gamesa, which is part of the Siemens group. So they're two very interesting stories, we think, that play to that theme. And the other thing that emerges out of this geopolitical fracturing is Europe's relative neutrality. And so if you can find a business that is set up to supply globally, that doesn't depend on low-cost manufacturing, hasn't outsourced all of its capabilities, and stands ready to provide both American and Chinese customers, that is potentially a very interesting place to be over the next decade. And the company we've talked about before that's been in the portfolio for a while is ST Micro, which is a semiconductor company. Unlike the trend that's happened in the US, they've retained all of their manufacturing at home. That is a good thing now. It bore a cost to shareholders for a long period of time, but they now own and control that manufacturing. And they have a breadth of capabilities that caters to everything from the Apple iPhone to the Tesla electric vehicle. And those commodities, when you add them all up, I think make that a very interesting story. So that's a name I'd sort of recommend people look at as well. We've owned it for a number of years, as I say, but the drivers of their growth seem pretty sound to us. So look, that's a bit of a sort of an update, our perspective. It's a really interesting time. We continue to find interesting stories, and I'll pause there if there's any you want to follow on, Louise.
Good on you, Graham. Thanks so much for kicking things off. So Mark's on the call, and Mark, I'd love it if you give your update now too. Thank you. Get yourself off mute.
You're on mute.
You're on mute, mate. He's got it.
Technology, hey? Always
Here
good.
he goes. Here he goes. Good on you, Mark. Thank you.
I was just saying that I'm the controversial guy who likes to say that the world's actually a good place to invest and the vaccine is going to save the day. So I'm not sure if you had a listen to the presentation we did yesterday, but there's a very detailed presentation we put out on the ASX yesterday if you want, I guess, the full story, but I'll give you a few of the highlights now. I guess the thing that we are most positive about is how negative everyone is. That would be the first thing. I mean, investor positioning, I think, is a very underrated aspect of investing. And I think we're contrarian and we like to be, sort of like what Buffett says, be fearful when others are greedy and be greedy when others are fearful. And we try to live by that. In terms of the parts of the market that we think are most exciting, it's definitely the value and cyclical stocks. I think growth stocks to us look incredibly expensive. I think it's been a well-deserved rally that growth has had over the last sort of a few years, but I think we've had this blow-off phase in the last 6 months or so where effectively, at least for Aussie growth stocks, they've put on about 15 PE points. So they've gone from roughly 30 to 35 times on average to about 45 to 50 times, which if you look back over the last 30 years, there's only been one time they've traded over 30 times, and that was during the dot-com boom. If you look at the last 30 years, the average is 24 times. You're now looking at 47 times for the average. So they're pretty extreme numbers. And I don't think even the bulls on growth stocks would say that they've deserved to re-rate by 15 PE points over the last 6 months. So most of these stocks, their outlook is modestly worse than it was before. The parts of the market that we like, there are 4 key areas. The first one is the COVID affected stocks. So companies that have been hard hit because their business or their industry has been very badly affected by COVID. I think they're pricing in a very large and permanent change in the profitability of those companies. I think in most cases that's not deserved, and these companies in most cases will recover most of that impact over the next couple of years. At the moment, sentiment towards the vaccine and COVID is incredibly bearish. We have done, I think I can honestly say we've done more work on the vaccine than any other fund manager that I know of. We've done more than 100 meetings to try and understand what's going to happen with the vaccine. Our head of healthcare at L1 is a medical doctor by background. His name's Andrew Lin. He also happens to be Chinese born, so he's fluent in Mandarin. So he's had conversations with not only the Western vaccine companies, but also the Chinese ones. We had a conversation last night with the director of operations for Pfizer, who is one of the front runners, getting very interesting detail about the prospects for their ramp up, likelihood of phase 3 success. We're very confident you're going to get success from at least one of the 8 players that are going to be finished their phase 3 trials towards the end of this year. The second area we like is monopoly real asset stocks. Companies like Chorus, Atlas Arteria, Horizon, these are companies with monopoly assets that can't be replaced. In most cases, they're doing normalized yields of 6 or 7%. Typically, you've got some sort of undergeared balance sheet on top of that, so you might have potential for special dividend and buybacks as well. And in a world of 0 to 1% bond yields, we think a very safe 6 to 7% yield in a monopoly asset is a pretty compelling proposition. It also provides a nice offset because some of our portfolio has a bit of a cyclical aspect, and this part obviously has a more defensive aspect. The third area is resource stocks at a cyclical low point. So as I said at the outset, we're very contrarian in the way we invest. We're very cautious on iron ore. Iron ore is the hottest and we would say the most overpriced part of the commodity space, but we like oil and we like coking coal, and they're both about as bombed out as you could ever imagine. Oil price obviously went negative, which is pretty hard to believe. You've had this massive glut because the entire world was not driving a car and not flying in an aeroplane. But obviously with our view that the world's going to recover and COVID's going to improve, we think you'll be looking at a much higher oil price, in 1 to 2 years' time. And then the last area is conglomerates with high quality assets and a valuation catalyst. So it's a very eclectic bunch of stocks, but it's companies like News Corporation, CK Hutchison, Vivendi, Iluka. These are companies where the sum of the parts is worth way more than the actual share price today. But in the past, the reason these shares have wallowed is because there hasn't been an event to trigger the share price to rally. So we think for a company like News Corporation, they'll do a restructure over the next 12 months, which will potentially see a spin out of their real estate portal business. So they own REA, a 61% stake in REA. They also own some other digital real estate assets around the world. Another non-core asset is the Wall Street Journal, which by itself we think is worth half the market cap of News Corp and is currently valued effectively at 0 because the market cap only reflects the value of REA and the cash on the balance sheet. And then in the case of Iluka, they've got a spin out of their mining area C asset, which is the BHP iron ore mine that they use Iluka's tenement for. So hopefully that gives you a sense of the areas of the market we like. We've also got, I'll just make a quick point of it, just in the interest of time. On page 11 of our presentation, we've got a couple of charts that show why we're positive about cyclicals and why we think the leading indicators are telling you that the world's about to get better. The 2 key factors are the ISM New Orders Index, which we think is the best predictor of future economic activity. That bottomed in March and April. It's now spiked from the low 30s up to 56 at the last reading in June. The second factor is the money supply. M1 is a great predictor of economic activity. It's about a 12-month lag from the time M1 increases to the time you get the increase in economic activity because you need the multiplier effect to come through. And essentially that's leading the market. We think that'll lead economic activity higher over the next year as well. So hopefully that's a pretty convoluted but somewhat coherent explanation.
That was great, Mark. Thank you so much. Guys, I wonder if you've got any questions or comments of Graham and Mark, because it might be useful to cover that off first and then...
let them go.
Yeah, and then they can go and then we can get into the nitty gritty on Future Gen if that works for you. You're on, Pete, you're on mute.
Yeah, you can see he's got a question burning.
No particular question. I think it's just good to get a bit of background about, your philosophy and your ideas about how you're structuring what you're doing. And I guess, from a micro perspective, probably leave that in Louise and Geoff's hands to be making good decisions about which fund managers they bundle up into the FG portfolios. But it is also nice to hear what you're doing in the background and have some understanding of why you're doing what you're doing.
Yeah.
There's no particular questions there. That was interesting information. Thank you. And I'll have a look at that presentation for sure.
Right.
I only had one question for Graham, back to you. It's just is around the gap, obviously the asset value versus the market value at the moment for you guys is a fair gap there, which I know we'll probably talk about in FG a bit more broadly as well, but it's just one that we actually do have, not just ownership through the FGG, we've also got clients that have got direct exposure to you guys as well. So just where that's at, is there anything that's happening to try and close that at the moment?
Yeah, I think technically I keep getting told by our executives at Antipodes that I'm not the person to talk about the listed vehicle because it's a board matter. But I can tell you that it has occupied the time of the board and the senior guys at Antipodes, and a number of actions have been taken, including a buyback. The move to more frequent NAV pricing, and then just ramped up communication. So I think I believe that the gap, the discount has closed somewhat from where it was, but it's clearly it's still fairly significant and well below where it was a couple of years ago. So just from our perspective as a manager, we are traditionally a value-orientated manager. Value as a style has been a headwind for us. So that, that's been, with a sort of lower net, so we're not fully invested. Our net has averaged about probably 65%. That has been a headwind against the benchmark, which has increasingly been driven by the mega cap growth stocks over the last few years. So that's been a headwind in terms of relative performance. But I just say that when we look through our portfolio today in terms of the sort of latent value in some of the higher quality companies, be they European companies like Siemens, EDF, etc., or sort of even growthier names like Taiwan Semiconductor, we do see a lot of latent value still to play out. And I think, if anything, the stimulus action is actually going to, I think it's already started. I think you're starting to see a transition to cyclical, to value. Growth will continue to do okay. It is a low rate world and these businesses will continue to grow. But I think the relative performance of value stocks, many of which are cyclical by nature today, is starting to turn. And, so that hopefully is a tailwind for us rather than the headwind of the last couple of years.
Thank you.
Any other questions? Jay? I think he's in the car, hey?
I'm not sure where he's going.
Exactly. He's in Victoria. He shouldn't be going anywhere.
Yeah, it should be
Love his picture.
To the pub. All right. Well, look, I think if I can just thank again Mark and Graham, we really appreciate you taking the time this afternoon to update the team here, but also for your tremendous support for FGX and FGG respectively. We can't thank you enough. It really makes a huge difference. So thank you.
Thanks, Scott.
Thanks very much.
You guys can
go. Thank you.
Yeah. We'll let you go. Get on with your life.
Okay.
Louise, my timing is, I've got a 3:30, so I'm next.
Yeah. All right. You are next, Geoff. Off you go.
No, but I'm not going to do. I just want to go Q&A mainly.
Oh, okay.
Obviously,
Right.
Ben, the question is, how do you get, whether it's L1 with their LIC or Antipodes with their LIC or Wilson Asset Management with our LICs? How do you get them to trade at NTA if not a premium? And it might sound simple. I mean, effectively, it's very complex. It's very hard to do. Very few people do it. but it's really, you need to engage with all your shareholders. So that, first of all, they like what you're doing and acknowledge them. And then your challenge is to get more shareholders. And obviously the more shareholders you get to buy, it's a supply demand and you can move it to NTA. Now, the thing is, you just don't know how much selling there is. You don't know how much of your shareholder base wants to leave. And we've seen it, like with the WAM products over the years, like the fact that listed investment companies are trading at discounts now is as stupid as the ones that are trading at premiums, like WAM Capital. 15% premium, how ridiculous is that? WAM Research, a 35% premium it's trading at the moment. I mean, how ridiculous is that? And then it's as ridiculous as the discounts. Now, everyone beats themselves up on the discounts. And see, you tend to find that the LICs that have been around for the longest will have a very tight shareholder base. So it's only a small movement in buying and selling, to actually keep it around NTA. It's like WAM Capital. White's, been staying up there and Wax. Like Wax, it actually took us 7 years to get it to NTA. It traded at a 40% premium at one stage. Now it's a 35% premium, which is as ridiculous as the 40% discount.
Yeah.
The future gem ones, like Louise will go through in detail. We've really got, the market's quieting down. Like there was a bit of noise last year about the commissions and that was sort of negative for the sector. A few people have gone off the sector. Oh shit, they don't understand. It's totally irrelevant for the sector, the commission stuff.
Yeah.
That was outside, but unfortunately the journos made a lot of noise. I mean, I think we had JB Weir the other day. We had a link up with them, and one of the guys said, "Look, do you think the sector will survive?" Hey, the sector's going to survive and it'll prosper. The great things about the sector is, your tax liability is what you get paid in your fully franked dividend. When you put your money in a trust, you could actually, like a lot of money moved into the sector after the GFC, because a lot of people put their money into trust structures which had unrealised profits. They actually lost capital and they got a tax bill. So so there are some, there are various other good benefits about the LIC. So the sector's here for a long time and it'll continue to grow. It won't grow at the rate of ETFs because it's a closed-end pool of capital. And it won't grow at the rate it grew at the last 6 years. Like the 6 year period was an abnormal period in terms of raising capital in the LIC sector, since the 20s, since it actually started. It was just, to me, there was demand. It surprised me. It kept going. So that's that. Now, FGX and FGG, we've got a really detailed strategy, which Louise will take you through. And I'm pretty confident. We've had them at premiums before. We've had them at discounts and we've got them back to premiums. I'm pretty confident we'll get them back to premiums. And already, we're sort of 20% through this part of the roadshow. After this part, then there's going to be a second part of the roadshow. So we're pretty convinced we'll get them damn close to there. With Antipodes, I mean, in theory, but what you don't know, you just don't know how much selling is coming. It's sort of like putting your finger in the dike. Yeah. Oh, we got it now. Now we're trading at NTA. Or, geez, is the hole that big? Is there this much selling? So, with Antipodes, like they had a tough period. And then when they had a tough period, then everyone sort of, oh, geez, have I made a mistake? So you just don't know what the supply demand is. They've done a buyback. They've done a couple of buybacks. Will that clean out the loose stuff? I'm not sure. But at some point in time, though things will get rationalised. You either get them back to NTA or eventually you get rationalised.
Yeah, I know that they one that they still make up. I can't remember the portion. They were a significant part of the FGG mix, weren't they? And they.
Yeah. What are they of FGG? Are they 8%, 9%? What is it? Louise, you're on mute.
9.4. 9.4.
Yeah. And like they they had a tough year last year. And the interesting thing is when you hear Marty about how we've actually been able to perform, again, it's part of the portfolio. Yeah, and we got all the smart guys. We've got all the boutique fund managers. Yeah, so but Marty will go through that in detail. It's just I've got to run to my 3:30. Any particular questions for me?
Nothing from, no, I think so. I don't think.
Okay, Louise and Marty will give you the meat on the bone.
You go. Thanks.
Okay.
Thanks, Geoff. Lovely to chat.
Sorry about that.
Stay well.
Louise, no, thanks. And Louise did warn me that Graham does like to talk. We should have, yeah, that was an error. I should have put him at the end.
Oh, I didn't realise till later. I went, ooh, that may not have worked. Anyway, but that's all right.
Hey, Jay, geez, you don't look anywhere as mean as you did when you... I love that picture. That picture is a cracker. Yeah. Anyway, sorry. Louise and Marty, you keep going.
We'll take it over. Okay. Thanks, Geoff.
See you, Ben. See you, Jay.
What we might do is, before I kick in, I'm going to ask Marty just to take you through some of the performance numbers. I mean, he's our key man that looks after all of the underlying performance reporting, and he's our key person liaising with the investment committee with myself. So he'll take you through some of the numbers. Thanks, Marty.
Thanks, Louise. Afternoon, guys. I guess just starting at the start. I guess the investment committee. So independent investment committee on both vehicles. Looking at the investment committees, and as I'm sure you guys are pretty aware, we've got representation there from JANA, Lonsec, Zenith, Morningstar, AMP. So big collection of asset allocators and research houses selecting our managers for us and assisting us with that asset allocation piece that we go through. I guess the asset allocation piece and manager selection piece, as we're going through that process, we're front of mind is always providing shareholders with hopefully better than market performance with reduced volatility and downside protection. So we're looking to do that not only by diversification of managers, but by diversification of those asset allocations. So we've got, broadly 50 to 60% long equities across both portfolios, with a 30% allocation to market neutral, absolute bias managers or managers with absolute bias characteristics, market neutral managers and cash. So broadly 50%, 50-50 of the portfolio. So long equities and defensive characteristics in the portfolio. And what's that's led to is great downside protection in the portfolio. Looking at FGX, since inception FGX in 2014, there's been 26 monthly drawdowns as measured by the All Odds Accumulation Index. Our investment portfolio has outperformed in 22 of those 26 drawdowns. So 85% of drawdowns we've outperformed. And that's led to a downside capture ratio of less than 60% since inception. Looking at FGG, it's got slightly higher beta in the portfolio, slightly higher exposure to long equities. So as you would imagine, slightly higher downside capture ratio at 70%. But I guess pleasingly with the FGG investment portfolio is over the last 6 months and the volatility that we've seen over the last 6 months, we've managed to stay true to label and provide shareholders with that downside protection and 72% over the last 6 months, in line with our long-term average. But we're also capturing 100% of the upside, through that manager selection process. Our long equity managers, an average weighted performance of our long equity managers is significantly outperforming the broader index over this volatile period. So Louise will talk about performance a little bit more, but I guess we're very pleased about the investment portfolio performance of the vehicles. They're outperforming now across all time periods, and a particularly strong 6 to 12 months. The FGX investment portfolio has outperformed by 6% in the last 12 months. And the FGG investment portfolio outperformed by 3.6% in the last 12 months. And as I said, 4.7% in the last 6 months alone. So, very well positioned to hopefully continue that outperformance, but still giving shareholders that downside protection and reduced volatility along what we're sure is going to be a bumpy road over the next little period. Thanks, Louise.
I might just take it over from here and just to reinforce that we are We are happy with those performance numbers, particularly in the last 6-12 months. We really think those numbers speak for themselves. And maybe in the past, when we look back, we're coming up to 6 years for FGX and 5 years for FGG. Sometimes we may have spent a little bit too much time on the charitable side of the business, and maybe historically we haven't stressed enough the downside protection and the defensive nature of the portfolio. And certainly that's what we will be doing more of going forward. I just want to touch firstly on dividends, and just to re-emphasise that we've always had a dividend policy since inception where we like to keep 1 to 2 years in reserve at the current level that we're paying a dividend in case of a severe downturn like we're currently experiencing. So the good news is that we are well placed in that regard. With FGX, we currently have 8.1 cents per share in the profit reserve. With FGG, we've got 6.8 cents per share in the profit reserve. And it's interesting, the distribution income final numbers are coming through, and it looks like, interesting enough, with FGG, we have a 40% increase in the distribution income this year. So that's quite encouraging. We're looking forward to announcing those dividends, and at a time when there's quite a number of companies cutting dividends or deferring payments, we certainly won't be in that space. So it is quite encouraging. So stay tuned for those announcements very soon. Now, just talking specifically about shareholder engagement, in January this year, both boards met together for a strategy day, and we've never actually had the two boards together meeting for a strategy day before. And the main outcome of that meeting was that we agreed to significantly resource up and boost the team for future generation for the first time. Because until then, it's really been myself who's been the only paid employee of both companies. And then I've had some tremendous back-end admin support from the WAM team, Marty, for instance, in operations, and his right-hand person, finance and comms. But it's now time for us to step up and tell that story stronger and better. It also means that it frees up my time. So I've got more time to concentrate on closing the discounts. So we've actually put on 2 comms people who are purely focused on future generation. One started in March, one started at the end of April. They're both funded by WAM, so there's a tremendous amount of generosity there, so they're not actually a cost to the companies. And we also put on a social impact manager at the end of May, and that person will manage the charitable side of the business again, so it frees up my time. Because what we're trying to do here, no great surprises, is stop any selling, but importantly promote more buying, whether that's from existing shareholders or new shareholders. And just to give you a taste of some of the initiatives that we very recently introduced, because we've got more comms resources, or some of the things we've got in the pipeline, I'll just run you through a few things. Firstly, we're increasing our number and frequency of shareholder calls. These are update calls. These are seeking feedback. We're doing the next round of those in early September. I do most of those myself. Most CEOs wouldn't bother. We think it is worth the time doing it, particularly at this point in time. We've also increased our number of investor conference calls. We did an extra one in April, for instance. We'll do the next one in September as soon as we've announced our half-year results. We converted our live investment forum that we've done in recent years in Sydney and Melbourne to a virtual event in May, and we're doing the next one in October. And converting it virtual, we had 40,000 views. Now, when we used to do that, we'd have 1,000 people in a hotel in Sydney and Melbourne, plus we'd live stream it. So that's where we have all the stock pick ideas from all the fund managers. So we're looking forward to tweaking that, lifting the bar on that event, and hopefully getting even more views when we do it in October. We've started a podcast series that I'm doing, and every month we're trying to interview a prominent Australian. I've done Joe Hockey, David Gonski, Anna Bligh. We're doing a Melbourneian next month. And again, this series is about lifting the profile and the brand awareness of Future Gen out there in the community. I've wanted to do that podcast series for a couple of years, but never really had the comms support to be able to instigate doing something like that. We've introduced.
Louise, is that on all the podcast streaming services at the moment, that podcast?
Yeah, it is. We're getting about 1,000 or so people per podcast. So, it's getting reasonably good numbers. And in fact, when I interviewed Joe Hockey, we hit the front page of the Australian, interestingly enough.
Yep.
It was only a small mention of FutureGen, unfortunately, but it's still, it was good that it was getting that traction.
What is the podcast name, Louise? Sorry.
It's called Conversations with Future Generation. Yeah. And it's on all the usual, whatever they are, those podcast platforms. I just haven't got it handy, but.
That's okay. No problem.
Should be able to easily find it, hopefully. Oh, it's on, actually, got it here. It's on Apple, Google, Spotify. At least those three anyway. Yeah. So we've also introduced a new quarterly update for advisors. Now, hopefully you guys got that just prior to this meeting. And that's something we launched last week. We're just trying to provide more information over and above what we're providing in our monthly NTAs. So if you've got any feedback on that, we'd really appreciate that, because that's the whole idea of doing that advisor update, is trying to, improve it every quarter that we do it. We're also doing more talks, presentations, more media. Again, we've got more comms resources so we can do more. Geoff and I did quite a big talk for ASA on impact investing a couple of weeks ago. I'm featured in Money Magazine this month. So we're trying to do more interviews with, your Comsex, your Switzers, AusBiz, the new TV, business TV channel, etc. We're also about to engage a PR agency, because what we're trying to do here is get ourselves out into more the mainstream media, not just the business media. So you'll probably see us start to be nominated for different awards out there, whether it's Telstra or EY or whatever. And again, it's all part of the strategy to build the profile and the awareness, because we know that's one of our biggest challenges, that so many people have not actually heard the story, know about the model, and the performance numbers are there. So, we really think that's what we've got to do. This virtual roadshow that we're in the middle of now is a key part of our strategy to close the discounts. The roadshow is predominantly for advisors. We're doing about 50 meetings in total. And next week, we're actually recording a version of this presentation that we're going to send you. And we're going to say to you, if you want to hand it on to your clients, by all means, away you go. So we're going to try and do a sort of client version and see how we go. It's a bit of a pilot. So, be a little bit different to what you're hearing now. But the thing about the presentation is we know we're getting some traction. So just so you know, we've probably done about 30% of the presentations. We started in the second week of July, and we are starting to reduce the discounts. So just so you know, with FGX, we're down to, what are we down to? I think 9.8%. And we were at 17% at the end of June. And with FGG, we've got a way to go. We were at 22 at the end of June. And I think we're at about 18% at the moment. So that's the one where we've got to work harder. But we're very confident, as Geoff said, that we will close the discounts. I mean, they've traded at premiums before. They've traded at discounts before. We've got a lot of experience in the WAM team on how to close discounts. It's pretty unlikely you'll see us, or not at this point. We're not going to be doing buybacks. We're not going to change the structure. Marty does a lot of analysis on buybacks out there, and we're not convinced that they work, particularly in the longer term, despite what some people might say. So it's not currently on our agenda. So we're taking a different approach to, say, someone like Antipodes. But we're very focused on that shareholder engagement comm strategy. We've got a strategy, we've got a plan. We're now just trying to, implement that as best we can. In conclusion, I think I don't need to tell you guys this, but the investor's getting a great deal. As you know, there's no performance fees that are paid, and instead of paying just over a 1% management fee, of course we donate the 1% to charity. Instead, the fees foregone since inception are $56 million, and the charitable donation is 30.6. So, there's no question there. There's a huge saving there alone if you just look at the fees that are foregone as well. So I might just sort of leave it at that. Oh, just one last thing. A lot of people ask us why the discounts are there. And I think the primary reason from our point of view when we've done the analysis is we did those placements, that capital raisings, as you know, at the end of 2018. And interesting enough, normally when you do a capital raise like that, you might get churn of about 30-odd%. And interesting enough, ours has been a bit higher. We've had between 35 and 40%. The lower figure for FGX because we didn't raise as much. FGG, it was more. So, that's been a bit tough. We've had some selling there that we wouldn't have necessarily liked. I mean, they haven't been long-term stayers, which is not what our typical, shareholder is. But that's really, the main cause of where those discounts have come from.
I think one of our biggest issues, which we've talked about this before, and we'd like to help close the gap, is if we could buy more of it, but we're really handcuffed on the platform at the moment. So, most of our holdings would be through North Super Pension, and we literally hold patterns. So, we've been able to still do it through our SMSFs and our investment accounts, but that's just obviously going to be an ongoing issue. I know it's no easy fix to that, but if that was not an issue, I've got no doubt we would have bought heaps. Like we would, because every time we can, we have been accumulating more of both funds. And I think, Marty, you were working on that. So I'm not sure if there's any update on that. I pushed really hard from our end and really didn't get anywhere. Again, we've been happy with all the things we've talked about. Fund holding up, defensive protection, the income being there as well. That's great. So we'd like to have more of it. It's just about that.
The last piece of information I got from AMP on the inclusion in the platform was they were taking a very simplistic view of listed investment companies, and their view was, my understanding of it was, your share price performance was top quartile you were in. If it wasn't, you were out. And to Geoff's point either earlier on this meeting or a previous one, that they're missing the whole point of the great opportunity with listed investment companies is you can buy $1 worth of assets in 80 cents, and you can only do that when the share price hasn't kept up with the investment portfolio performance. And it's, I guess, to me, they're giving you access to listed investment companies whose share prices has either outperformed its NTA or no correlation to its NTA. And they're not allowing you these great value opportunities. But unfortunately, me telling them that doesn't carry much weight. And I know you guys have tried. There's a few others that we've got, and AMP and North have been particularly problematic for us, and we haven't been able to get around it. Look, once we've closed the discount and we're trading at a 10% premium, they'll put us back on because we've got great share price performance. It's
crazy.
It's very frustrating.
That got on in the same period of time when you guys got kicked. You guys didn't get on, and some other funds like Antipodes got added who performed worse on their own. So it's just the crazy metrics that they use. I suppose we can always go back to them again whenever we think.
It's also frustrating for us because we have one of the senior guys at AMP Research, is on our investment committee. So that's tough too when you can't even anyway. No,
but look, if you guys want to keep chasing from your end, I'm actively kicking them every couple of weeks and reminding them that I'm not going to go away. And I think, as Louise said, obviously we're going through this roadshow at the moment for advisors and brokers. We're moving on to high net worths, and we'll probably break off at that stage. Louise will look after high net worths and charitable foundations, and I'm going to focus on all those wraps and platforms. So it's the next couple quarters, I'm hoping to maybe not face to face, but sit down with all the research behind the platforms and build more of a relationship there. It's not something we've had to do before. We've just been we've been there, but I think the shakeout from especially probably the overhang from the Royal Commission is that you need to be in front of them a little bit more and treat them as a client as well, the same as we would you guys, and engage with them differently. And that's part of our engagement strategy that we're going through as well.
Any other?
It was just interesting. The panelists we had all had licks. I wonder, 2 of them are doing buybacks, so we could have had the debate with them on the merits of buybacks with the panelists we had.
And we didn't choose them. We didn't choose them. You guys chose them, so that was interesting, wasn't it? That's unusual.
I remember Geoff saying Geoff's not a fan of buybacks.
No, he's not. He's not.
No, never has.
And the L1 buyback in particular is very interesting. How aggressive they went with Mark and the other co-founder buying themselves, and then they went aggressively into the buyback. And they're on average between 15-20% of volume. And in those first couple of weeks when they signaled there was a buyback, it dented the discount, and it's blown back out again. So it's it backs up Geoff's thesis that it doesn't how big's the selling behind there? It doesn't necessarily mop it up. You've got to change shareholders' mindset in relation to the entity, and you can do that with strong investment performance, which we're doing at the moment, and obviously that shareholder engagement piece on the back of it to make sure your message is getting out there.
It's also interesting that the chairman of FGX, Jonathan Trollope, also chairs the Antipodes League. So and he's not supportive of a buyback with us.
Yeah. Is the Morphic fund? Is the Morphic fund still in the FGG mix?
It is. Yep.
Is that one that's had some issues with it as well? From speaking through, did they just from our link through Hamish Valletta? I can't remember what he sort of flagged. There was some challenges with the fund inside of it.
Well, they've had that change of ownership with Elliston. They've been under watch with us for a little while. It's they're under watch, so they could be performing a bit better, but they've been okay. I don't know, Marty, if you want to add a bit more on them.
I think when we had the pre-meeting for the FGG investment committee late last week, and we were talking about them into that point, and their listed investment companies got different issues, and it's obviously at a discount as well. But within their fund, their performance is actually not that bad. From an absolute bias manager, they've performed pretty well through the last 12 months. So their performance isn't bad.
Maybe that biggest difference between the listed option and the direct is that they're probably the issue.
Yes, and we have a little bit in both. We've got a little bit in the listed option as well.
Yeah.
When we did the capital raising back in 2018, we had the option to upscale our investment in their trust, or at the time there was a line in their LIC MEC as well. So it was why put your money in a trust when you buy it at a LIC at an 18% discount. Unfortunately, they haven't closed the discount, and we've offered to help them with the Geoff Wilson playbook, whatever you want to call it. We've offered to help, and they've gone through this merger with Elliston now, and Elliston's closing down their LIC. They're converting that to a trust. So I don't know if that similar fate will play out to MEC, but there's a value opportunity there should they go down that path.
Yeah. Thank you.
Is there any of the fund managers you've got that you're considering moving on? Is there anyone you're looking at that you'd be looking to add? Is there any room to adjust the current holdings inside the mix?
Yeah, you happy for me to talk, Louise?
Yeah, you go, Marty. Yep, go for it.
Look, there's probably more action on the horizon for FGG. One of the managers redeemed or closed their shops, and we were a forced redemption as a result in March. They did a great job of picking the bottom of the market, started to liquidate their portfolio kind of between the 16th and the 25th of March. They liquidated their portfolio. And obviously between the 23rd and 31st of March, the US bounced back 15.5%. So we managed to get out right at the bottom. which was disappointing for us, but it was forced upon us. There was nothing we can do. So at the time, that was about 5.7% of the portfolio, and FGG was already sitting with 9 to 10% cash. So we like to keep a cash buffer of about operating cash of 2 years. So for FGG, given the slightly lower dividend payout ratio, it's about 4 to 5%. So we've got room to move that cash down a little bit. We upweighted Munro and Nico Partners by 1% each, just at the end of June, end of May, and we're in discussions with potentially 2 new managers at the moment that we'll pull in, and there's maybe 2 or 3 others that we're looking at. With FGG, we do it's a bit more of a concentrated portfolio, and we don't have the tail that FGX has, and we look to initiate managers at about that 3%. So it's a lot more higher conviction decision-making process there, and we're looking to maintain our smaller manager pool, or the investment committee is looking to maintain that smaller manager pool. So, when it comes, it'll be 3 to 4% investment. So use maybe 1 or 2 new managers coming in there. We've recently changed the chair of the investment committee at FGG, and John Coombs from JANA, who's on the FGX investment committee, is also going to join us on the FGG investment committee. So a bit of a refresh of personnel there, and then maybe change of ideas. So that'll go through the wash in the next couple of weeks or months. So nothing imminent at the moment. One of the other levers that the FGG investment committee in particular were talking about was switching out of, changing the asset allocation of the portfolio. So as we went through, COVID, we had, an emergency or an extra investment committee meeting in February. Antipodes were on the call. We are invested in their global product, which is long short. They run a long only version of the product as well. So there was the potential lever to change the dynamic of the portfolio when we got to the bottom is cycle out of that long short portfolio and go into a long only portfolio and dial up the risk of the portfolio a little bit, as we thought we're coming out of a bottom. Obviously the correction and bounce back was swifter than anybody would have anticipated. And it wasn't something that we pulled. So we remain in the long short product. But that's something that we could do, I guess, just to change that portfolio composition if we were to go through another downturn and more of a sustained downturn to allow us to pull that lever. And we thought there was blue skies ahead and a bit of a tailwind for long equities coming out of it. With that cash that you were talking about before, do you make the and that would get invested, or would you select a new manager that would just simply go into their fund and trust them to manage that alignment, or would you sit on that opportunity you've got to select a new manager until you thought it was opportune? Who picks that side of it? It's an investment committee decision. Generally, we try and not be cute about picking the bottom or the top of the market, and it's more time in the market than time in the market, I guess. So it's more been, it's been led by going through the due diligence process with the managers, getting comfort, getting them to grant us capacity on a pro bono basis, and going through the operational mechanics of it, and not, we're going to wait till the market's off 6% and pull the trigger then. So there's a little bit of that. FGG, I think FGG in particular, when we did the capital raising back in 2018, we didn't invest until late 2018, early 2019. So we let that, there was a little bit of volatility there. We let that wash out, and that definitely contributed to our performance over the period. So we have that flexibility, but obviously you don't want to miss an opportunity as well. So yeah, that makes sense.
Just one question for either of you. I understand that FGG, by the nature of what we use, international stuff, the dividend is always going to be lower than we can do with FGX and Australian companies. Is there any opportunity for that to be increased, even if it's only marginally, just to add a little bit of attractiveness to that on top of capital growth? But again, for a lot of clients, the dividend becomes a key talking point.
Yes. Well, look, Peter, obviously I can't say too much, but we'd like to be able to do that this time round. So I think I mentioned before, we have had a 40% increase in the distributions. So we are in quite good shape with FGG. So I'm hopeful that we will be able to increase. Yeah.
Right. Yeah, and that would be, do you think that would be sustainable?
Well, that's the plan. Like looking at what's in the profit reserve at the moment, I think we've got 6.8 cents per share. So that, you know, we could, for instance, increase it up to about 2 cents as a probably quite easily, and then have a couple of years at least at that current level, assuming we don't get any more distribution income in future years, in the next 2 years. So it's looking good for an increase. Yeah.
Great.
It's never going to be the same level as FGX. I mean, that's just the way it is because of some of those fund managers being domiciled offshore. We're just not picking up distribution income from some of them. Yeah.
And I accept that, as do most clients when you have that conversation with them. But if the gap can be closed a little bit, it's a lot easier. The conversation is a lot easier to have with a client if you're looking at 2% plus franking.
Exactly.
If you're sort of pushing it out to about 3%, if you've got a good buy at a good price and it's performing well in every other sense, it's easy to continue to argue as it's a great one to keep holding, or when we can buy because it's a good long-term option.
Yeah, exactly. And look, obviously we'd be keen on an increase because with the work we're trying to do now and closing the discounts, it'd be perfect timing if we can. Yeah, yes, but obviously it's a board decision.
Yeah, that's okay. Awesome. Well, I think that's, from my perspective, that's a great presentation. It's a really good update, and thanks for taking our questions, guys. It's always nice to chat to you, and we look forward to, again this year, being able to distribute some lovely donations to some suitably happy charities around our client base groups.
Yeah.
I think that's it.
Yeah, well, that's great. Look, thanks for your support. I mean, the donation voting will open on the 6th of August and it'll close as usual on the 31st of August. And I'll be in touch with Amy around about the 6th. This year, for the first time, we're just introducing a standard form, template form for all advisors like yourselves that do the aggregation. So it's same information you supplied before, but we're just going to give you the form to complete. You know what I mean? So the good news is that the donation is up to 10.5 and it was 9.5 last year. So, the good news is we're still, despite, what's happening with the market and the economic downturn, we've managed to increase it again. So it's good news for the charities. Yeah.
And again, the clients, as I said, I think when we met in Melbourne, probably 2 years ago now, I said to Geoff, we love the concept, we love being involved in it, and we love what it allows us to do through our client base. But we just need to make sure that it continues to perform at least reasonably well so that we can continue to justify holding the shares. And, I think the last couple of years, obviously, like a lot of things fell away, but we're heading in the right direction now.
Yeah.
So that's awesome. Thank you.
Good on you.
Enjoy being part of the organisation.
Thanks, Jay, as well. Thank you very much, Peter.
Thank you. No worries. Thank you very much.
Yeah.
I look forward to listening to your podcast, Louise.
Oh, good on you, baby. Let me know what you think.
Yeah, absolutely. No, I'll share that. The last sort of few months has been a bit of a change for us in our sort of PR as well and communications with our clients. So they've been very receptive. We've done a little bit with Hamish in terms of communicating a little bit more directly, using technology with our clients. So I think they'd be certainly open to any of the communications coming from yourself. So we'll share the podcast with the clients, and I'm sure it'll be well received. I'll have a listen tonight.
I think the Joe Hockey one is probably the best. I've done 4 so far, and I think that's probably the best one. But if you're going to choose one, I'd choose that one.
I'll jump onto it tonight.
Yeah. Okay.
Very good.
Good on
Thanks,
you.
Louise.
Guys.
Thanks, Martyn. Cheers.
Nice. Thanks, guys.